Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, stocks are losing money and bonds are netting to zero. The drama and headlines not only continued, I'm going to just quit saying that, but ratcheted up with the war in Iran. Yet corporate earnings remain healthy so far. Interest rates rose, a surprise pivot. Usually, war evokes a run to treasuries and depresses rates. Inflation remains elevated and headed higher, but temporarily, we hope. The roiling of tariffs remains, but off the headlines. At quarter end, U.S. large company stocks lost 7%, small companies dipped 3%, overseas stocks were damaged, only down 1%, although higher energy costs hit them harder over there. Bonds held, giving us at least a positive 0.4% return. Of course, now there's an exuberant market snapback since the words ceasefire are in print. Pros say that the market senses that we are moving past the peak of uncertainty. We'll see. Let's move through the U.S. economy, corporate earnings, geopolitics, interest rates, overseas, and how the portfolios are holding. 2025's economic growth GDP settled at 2.1%. Fourth quarter came in at 0.5% growth. The Atlanta Federal Reserve's GDP Now tool is forecasting 1.3% for first quarter 26. For context, the last 5 years' GDP growth rates have been 2.1%, 2.8%, 2.5%, 2.1%, and 5.8% in 2021. Consumer spending is estimated at 2.1% for 2026, following 2025's 2.7%. The fall in immigrants spend money, and eroded purchasing power, wages are not growing as fast as prices are inflating, are reasons for that. Job growth continues to waffle. March showed a strong rise in jobs. February showed a decline. Unemployment remains stable around 4.3%. The labor force, the number of people working in the U.S., has declined materially from immigrant laborers being deported, very low new immigration, baby boomers retiring, and a low U.S. birth rate. Inflation is running around 3% annually and trending higher, above the 2% target. Corporate earnings continue to be healthy, forecasted at 13% growth for the first quarter and 11 to 14% for the year. Corporations are doing well so far. Higher energy costs and a squeezed consumer would change that. The US dollar rose some initially on the war. That correlates with risk in oil prices, but has dropped back with the ceasefire rumor. Geopolitics? In March, the war in Iran spooked the market, driving prices lower. Usually a crisis sparks a run to U.S. treasuries, driving up prices and lowering yields. That didn't happen this time. U.S. treasuries are not such a favored safe haven these days. Bond yields actually rose from below 4% to over 4.4%. Prior to Iran, in February, the Supreme Court ruled the emergency tariffs under the Trump administration were invalid, that tariffs collected should be refunded. That boosted stock markets. The Trump administration is now attempting to impose replacement tariffs under a different statute. That dampens stock markets. In January, the military operation which removed Maduro in Venezuela had mixed impacts on our markets. Think defense and energy stocks, gold, US dollar. The Federal Reserve has held interest rates on the short end steady since November of 2025. The rate remains at 3.5%, balancing forces between inflation that argues for higher rates and a possibly weakening labor force. Fewer new jobs argues for lower rates. High political pressure from the Trump administration remains. The term for current Fed Chair Powell ends in May. Pros view the candidate the administration has nominated to replace Powell as creditable. Good news. We now have two wars, that in Ukraine, Russia, and now in Iran and Lebanon. Military operations have calmed in Venezuela. These impact markets, oil companies, defense stocks, commodities, oil and gold, and bonds to some extent. The stock market's lack of response to the opening salvos of the Iran war leads some to speculate that investors are either becoming inured to the impacts of tariffs and wars or more swayed by the anticipation of growth from AI, artificial intelligence. Perhaps truth is in the middle. What does 2026 look like now? Price earnings ratios, usually within a 12 to 22 range historically for the S&P 500 companies, have come down to 20 times $1 of expected earnings. Most pros believed growth would slow some in 2026, but we're not expecting a recession, unless geopolitics interferes now. The long-term return for the S&P 500 stocks is only 10%. We've enjoyed excess returns in recent years. We've worked hard to insert diversification and higher quality investments into the portfolios, and it's paid off for investors. When the stock market was down 7% at quarter end, our portfolios using the core funds were off less than 1%. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.